that. Have you ever wondered what really happened in 2008? One moment, the world economy seemed fine, and the next, it was on the brink of collapse. This wasn't a movie plot. It was the great financial crisis, a storm that reshaped our world. Today, we're going to break down exactly what happened, why it happened, and why it still matters to you. It all starts with something that sounds pretty boring: the housing market. For years, leading up to 2008, there was a belief in the United States that house prices would only ever go up. This created a massive housing bubble. Lenders, driven by the desire for big profits, started handing out mortgages to almost anyone, even those with poor credit and low incomes. These were called subprime mortgages. Think of it like this. Imagine banks started giving out sports car loans to people who couldn't even afford a bus pass. All because they believed the value of used sports cars would skyrocket forever. It sounds risky, right? Well, that's exactly what was happening with houses. But the risk didn't stop there. Wall Street got creative. They bundled thousands of these risky mortgages together into complex financial products called mortgage-backed securities, or MBSs. They then sliced these bundles into different pieces, got them rated as super safe investments, often with a triple-O rating, the highest possible, and sold them to investors all over the world. Pension funds, insurance companies, and even other countries bought these products, thinking they were making a safe bet on the stable US housing market. The problem was, the foundation of this entire system, the subprime mortgages, was incredibly shaky. Many of these loans had low teaser interest rates that would suddenly jump after a couple of years. When those rates reset, homeowners couldn't afford their monthly payments. One by one, they started to default on their loans. This is where the dominoes began to fall. As more people defaulted, more houses went into foreclosure. A flood of houses for sale hit the market, and with so much supply and not enough demand, prices didn't just stop rising, they started to crash. The housing bubble had burst. Suddenly, those super-safe mortgage-backed securities that investors had poured trillions of dollars into were revealed to be filled with worthless loans. Their value plummeted. Financial institutions that held huge amounts of these toxic assets started to panic. They had borrowed massive amounts of money to buy these securities, and now they couldn't pay it back. The trust that holds the entire financial system together evaporated overnight. Banks stopped lending to each other because nobody knew who was solvent and who was about to go bankrupt. Credit, the lifeblood of the economy, completely froze. The first major casualty was Bear Stearns, a major investment bank, which was sold for pennies on the dollar in March 2008 to avoid a total collapse. But that was just the appetizer. The main course arrived in September 2008, a month that will live in financial infamy. On September 15th, Lehman Brothers, a 158-year-old giant of Wall Street, filed for bankruptcy. The US government decided to let it fail, hoping to send a message that it wouldn't bail out irresponsible firms. But the effect was catastrophic. It was like pulling a critical support beam from a skyscraper. The global financial system went into a full-blown meltdown. The stock market nosedived, panic spread across the globe. In the following days, the crisis escalated. The insurance behemoth AIG, which had insured trillions of dollars worth of these toxic assets, was on the verge of collapse. Its failure would have been even more devastating than Lehman's, fearing a complete economic apocalypse. The US government stepped in with a colossal $85 billion bailout. This led to one of the most controversial government actions in modern history, the Troubled Asset Relief Program, or TARP. The government committed $700 billion to buy up toxic assets and inject capital directly into the banks to prevent the entire system from imploding. These were the infamous bank bailouts. The logic was that these banks were too big to fail. Their collapse would take the entire economy down with them. While these actions may have prevented a second Great Depression, they were incredibly unpopular. Many people on Main Street who were losing their homes, jobs, and savings watched in anger as the very institutions that caused the crisis were bailed out with their taxpayer money. The impact of the crisis rippled out from Wall Street and hit every corner of the globe. The US entered a deep recession. The unemployment rate soared, millions lost their homes to foreclosure, and retirement savings were wiped out. It wasn't just an American problem, because the global economy is so interconnected. The credit freeze and economic downturn spread to Europe, Asia, and beyond, triggering a global recession. In the aftermath, governments around the world scrambled to make sure this could never happen again. This led to sweeping new regulations in the US. The Dodd-Frank Act was passed in 2010. It aimed to increase transparency and accountability in the financial system, create new consumer protections, and give regulators more power to oversee large financial firms. The idea was to end the too-big-to-fail problem and prevent the kind of reckless risk-taking that led to the crisis. So, more than a decade later, what are the long-term effects? The economy did recover, but for many, the scars remain. The crisis fueled a deep-seated distrust in financial institutions and government. It widened the gap between the rich and the poor, as many ordinary families never fully recovered their lost wealth, while the financial markets eventually bounced back. It also fundamentally changed how we think about the economy. The belief in lightly regulated, freewheeling markets was shattered. It sparked debates that continue to this day about the role of government, the ethics of finance, and the fundamental fairness of our economic system. The 2008 financial crisis wasn't just a collection of numbers on a chart. It was a human story of lost homes, shattered dreams, and a global wake-up call. Understanding it is crucial because the decisions made in its wake continue to shape our world, our politics, and our financial futures. The system is safer now, but the memory of 2008 serves as a powerful reminder of how quickly things can unravel when greed and complexity spiral out of control. Thanks for sticking with us through this deep dive. If you found this explanation helpful, make sure to hit that like button and subscribe for more content that breaks down the big events that shape our world. Let us know in the comments what other major events you'd like us to explore. See you in the next video.